Which mortgage repayment is better, regular principal and interest or interest only? I actually created two examples that are here and we're going to go over them in detail, so please watch this video to the end. But I will tell you that both of them have advantages and disadvantages. One is more affordable but doesn't really build you any equity, which is interest only, and the other one, the regular one, is a more traditional one where you have the set payment. It doesn't change. However, it's a little bit higher than interest only because you're repaying the interest. So let's go through the example. I invite any comments, likes, and suggestions, questions. So let's learn together. We're going to distinguish between principal and interest repayment, like the regular way that mortgages work, and then also interest only, and what are the advantages and disadvantages of both. As you can see in my example, these are my parameters. So the loan amount is 500, interest rate is 6%, we're repaying it over 30 years. The payment is always the same. Payment is always the same, almost $3,000. First month, the interest is $2,500, the principal is $497. We're giving the bank $2,500, and we're repaying to ourselves $497, and the balance is $499,502. Notice how in the second month, the interest already goes down because it's calculated based on the balance, and your principal goes up because the total always has to be the same. So that's how people build equity. You see your principal repayment goes up, your interest repayment goes down, but the total is always the same. And some people say, well, you don't really pay any principal the first 10 years. As you can see, it's not really true. After the first year here, person paid almost $6,500 back to himself. Compare it please to the interest-only example, which is right here, same parameters, 500,000, 6%, and the payment is only $2,500. Look, contrast the payment. It's $2,500 here and $2,997 here. Okay, so you pay less, but the balance doesn't change. It still stays the same at 500,000. And at the end of the year, at the end of 1 year, it's still the same. So this will obviously help you qualify easier for the loan because the payment is lower in many cases, but as a trade-off, you're not building any equity.